Today, we're looking at excerpts from The Simple Path to Wealth.
Right. This book, it's got some strong opinions, personal stories, very clear instructions on finance and investing.
Definitely direct. So our mission today is really to pull out those core ideas, understand the why,
And see how they might connect to your own financial path.
Yeah. Keeping in mind, of course, we're exploring these ideas from this source. This isn't personal financial advice.
Absolutely. Ready to get informed? Fast.
Let's jump in.
Okay, so the core philosophy. It sounds almost too simple. Sound investing isn't complicated. That's the claim.
That's the starting point. And the key actions are laid out really clearly. First, save some of every dollar you get.
And the more the better.
The bigger the percentage? Yeah, absolutely. But second, invest what you save. That's surplus.
Okay.
And third, maybe the most crucial bit, avoid debt, like the plague.
That high savings rate piece. There's the sort of double benefit there, isn't there?
Exactly. It's not just about having more money to put to work.
Right.
You're also simultaneously training yourself to live on less, building that discipline.
Yeah, building the muscle. Which leads into this concept the book calls, well, FU money.
Yeah, provocative term. Apparently from a James Clavell novel, Noble House.
And the point isn't just having, enough cash to finally retire someday, way off in the future.
No, it's more immediate. It's about having enough financial cushion to gain freedom now.
Freedom to negotiate.
Yeah, or to just walk away from a bad situation, a job you hate, whatever. It's money that buys you options leverage.
The author tells a story about this, hitting that point quite young, age 25, with just $5,000 saved.
Which felt like a fortune then, apparently.
Yeah.
Enough that when they were denied unpaid leave from their first job,
They just went anyway.
took the trip, used that cushion. But the real lesson wasn't just the travel.
What was it?
It was realizing the power dynamic had shifted. They learned their relationship with the employer was actually negotiable.
So having that backstop changed things.
Totally. They later went back and successfully negotiated for more vacation time. That money bought actual freedom from feeling trapped.
And it wasn't just about personal trips. There's another anecdote.
Right, about how that FU money enabled the author's wife to stop working, become a stay-at-home mom.
The framing was valuing time with their daughter more than stuff.
Yeah, more than the things a second income could buy. A conscious trade-off.
And that cushion was vital later on, too, wasn't it? During unemployment after 9/11.
3 years unemployed. That savings buffer was critical for security. Shows the power of having built that base.
It really throws into relief those cautionary tales, like the one about Mike Tyson.
Oh, yeah. Earning, $300 million? Incredible sums.
But ending up bankrupt. The book points to lifestyle costs, like $400,000 a month.
Yikes. And just focusing on buying things, not actually building sustainable wealth.
It's a stark contrast. Wealth isn't just earning, it's keeping and how you use it.
Which brings us to a pretty bold question the author asks. Can everyone actually retire a millionaire following this path?
Sounds like a stretch, but the book says maybe yes, at least for middle-class earners, backed by historical data.
Qualified, yes. They use S&P 500 history, 1975 to 2015. Saving just $130 a month.
Okay, that's $1,560 a year.
Right. Over that 40-year period, it grew to nearly $1 million.
Wow.
Bump it slightly, $150 a month, so $1,800 a year. Over $1.1 million.
It's hard to wrap your head around that kind of growth from relatively small, consistent amounts.
It's the magic of compounding, right? That's the engine. Time is your friend.
So starting young helps massively.
Definitely gives you a longer runway. But the core point is, consistent saving and investing works. It's achievable. It's never truly too late to start building.
Okay, so we've covered saving, investing the surplus. Let's flip it. What does the book say is the biggest danger, the main obstacle?
Yeah, this is where the book gets really, really emphatic. The single most dangerous thing. Debt, period.
And the perspective is pretty sharp. Debt is seen mainly as a marketer's tool.
Exactly. How else do people buy $32,000 cars on average? Or take on 6 figures for college? It's the financing making it seem possible.
And the scale of it is huge. The book cites around $12 trillion in U.S. debt at the time.
Massive numbers, like $8 trillion in mortgages, $1 trillion in student loans, $3 trillion in consumer stuff cards, auto loans.
It's just become normal.
But the downsides listed are, well, they're heavy. Debt eats your lifestyle through interest. It enslaves your income, right?
Yeah.
Limits your choices dramatically.
And the stress. The book uses the phrase buried alive.
Yeah, and the emotional toll. Shame, guilt, feeling trapped, helpless. It can even push people towards, bad coping mechanisms, more spending sometimes, ironically.
And it keeps your focus negative, stuck on past mistakes, present pain, future worries. It gets baked into your thinking.
So if you do have debt, the advice is blunt.
Pay it off. Top priority.
Absolutely.
Yep.
Especially anything over, say, 5% interest, even if the math might look better investing elsewhere sometimes.
The psychological win is huge.
Huge. Getting free from debt is foundational. The peace of mind is invaluable.
And there's a silver lining to that struggle, right?
Yeah. Once you've mastered living on less to kill the debt, you've built the exact habit you need for financial independence.
You just switch gears.
Redirect that money. Instead of paying down debt, you're building up assets, watching wealth grow instead of debt shrink. The book frames debt like an emergency you need to escape. You weren't born to be a slave to it.
And this tough stance applies even to so-called good debt.
Yep. Business loans, seen as dangerous, needing real caution.
Mortgages.
Viewed skeptically, too. The idea is easy mortgages tempt people into buying way more house than they need or can truly afford, often pushed by the industry.
So houses aren't seen as great investments in this view.
Generally not in the same way stocks are. They cost money, upkeep, taxes, insurance. They're more like expensive indulgences. The real issue is the massive debt taken on to get them.
The student loan section, that's particularly striking.
Oh, yeah. The author contrasts their own college cost maybe $1,200 a year back in the late 60s, early 70s, to their daughter's experience decades later. $40K a year for state school, $60K for NYU.
The numbers are just staggering.
Right. Consumer prices went up maybe 6 times between 1970 and 2014. College costs 33 times.
What's the cause, according to the book?
Partly, it's the easy availability of student loans flooding the system. Universities can then charge more, build fancier things, pay huge salaries.
Like presidents earning $500,000 plus, up from maybe $25K?
Exactly. And the consequence, it kills off truly cheap living options for students. Education becomes less about exploration, more about expensive job training just to pay back the loans.
Shackling young people right out of the gate.
Prevents them from taking risks, exploring different paths, and the real kicker.
What's that?
Student loans are almost inescapable. They survive bankruptcy, they can follow you forever. Garnish wages, even Social Security later.
Which raises that ethical question the book poses, pushing 17, 18-year-olds into this massive lifelong debt burden.
Yeah, kids with often very little financial understanding. The conclusion is pretty stark. Living paycheck to paycheck makes you a slave to the job. Having debt, that's even stronger shackles.
Okay, so you fight your way out of debt, build that savings habit. Where does the money go?
Right, the investing part. The simple path says you need to be in the stock market.
And right away, it dismisses market timing, trying to guess the highs and lows.
Totally. Says nobody can do it reliably. Even that famous Warren Buffett rule, never lose money. It's not about avoiding temporary dips.
It's about avoiding dumb mistakes, like panic selling.
Exactly. Avoiding permanent loss through bad decisions, not avoiding the market's natural ups and downs. Which brings us to how the book views volatility.
Crashes, corrections.
They're presented as totally normal, expected, part of the deal. Not disasters to be feared, but predictable patterns.
And history shows the market always comes back.
Always recovers, always trends up over the long haul. Maybe not every day or year, but the trajectory is up.
The book lists all sorts of crises.
Oh yeah, the 70s recession, crazy inflation, that Death of Equities magazine cover in '79 that ironically marked a bottom.
Right before a huge bull run.
Exactly. Then the '87 crash, early '90s recession, tech bubble bursting, 9/11, 2008.
A lot of turmoil.
Through all of that, the Dow, reinvesting dividends, still averaged nearly 12% a year from '75 to 2015. Incredible resilience.
So the defining factor for wealth isn't catching the highs.
It's how you react to the lows. Can you hold steady? Can you resist the panic? That's the simple path discipline.
And the pool for this, it's surprisingly simple.
VTSAX, Vanguard Total Stock Market Index Fund. That's the core recommendation.
Why that one?
Because it owns a tiny piece of basically every publicly traded U.S. company. Around 3,700 of them. Massive diversification.
And it's self-cleansing.
Yeah, meaning as old companies fade, new successful ones automatically rise within the index. You're always owning a slice of the current American economy, living, breathing businesses.
If it's this simple and effective, why don't more people succeed?
Our own brains, basically. The book argues we're psychologically wired against staying calm during volatility. It feels wrong. It takes conscious effort to override that fear.
And the data shows investors often underperform their own funds.
Sadly, yes. Because they try to time it. Jump in after a run-up, jump out after a drop, buying high, selling low. Classic mistakes.
The book also warns against thinking you can pick winning stocks.
Says it's nearly impossible consistently, even for the pros. Same for picking winning active mutual fund managers.
High fees are a killer there too.
Huge drag. Plus, the industry tends to bury the funds that fail and only highlight the temporary winners. It's a confusing landscape. More funds than stocks.
This leads to that analogy, the beer versus the foam. I like this one.
Yeah, it's helpful. The market has two parts, right? The beer is the real stuff. The underlying businesses, their earnings, their value.
Solid.
Tangible. And the foam. That's all the day-to-day noise. The price swings, the CNBC chatter, the gurus predicting the next crash or rally.
Exciting, maybe, but useless.
Worse than useless, according to the book. It's distracting. It triggers those emotional, fear-based reactions that lead to bad decisions. Focus on the beer. Ignore the foam.
Solid advice. What about the really big, scary one? 1929.
Address directly. Acknowledges the brutal 90% drop, peak to trough. Devastating.
But rare.
Extremely rare. Once in over 115 years. And the counterintuitive point, if you're young and investing, a crash is actually a gift. You get to buy assets super cheap.
Sets you up for huge future gains.
Exactly. The book also mentions hyperinflation as the other big wealth destroyer and notes that stocks, owning real businesses, tend to be a decent hedge against that too. Assets and prices rise with inflation.
Okay, so let's boil down the toolkit. Just 3 things needed.
Pretty much. VTSAX, the total stock market fund. VBTLX, the total bond market fund. And cash, just regular cash in the bank or money market.
And their roles.
VTSAX is your growth engine, your inflation hedge. VBTLX is for stability. It smooths the ride, dampens volatility, provides some income, and hedges against deflation. Cash is for everyday needs, emergencies.
And the book stresses that safety is kind of relative.
Yeah, it's an illusion in some ways. There's no zero-risk investment. Cash loses value to inflation over time. Stocks bounce around. Bonds have interest rate risk.
So you're not avoiding risk, you're choosing which kind.
Precisely. Which risk aligns with your goals and timeline? That leads to the idea of 2 main stages.
Wealth accumulation.
Right, when you're working, saving, actively adding money, building it up.
And wealth preservation.
That's when you slow down or stop earning and start living off the investments. And importantly, these aren't strictly tied to age. Life happens. You might shift back and forth. Flexibility is key.
Okay, so how does the portfolio look in each stage for accumulation?
Especially if you have decades ahead. The recommendation is bold, 100% VTSAX.
All in stocks.
Yep. The logic is, with a long time frame and ongoing contributions, market drops are your friend. Buying opportunities.
Put all your eggs in one large, diverse basket.
Add more whenever you can and forget about it. That's the quote. Simple, aggressive.
Then for preservation, when you need income and less bumpiness.
That's when you add bonds, VBTLX, to smooth things out. The exact mix. Stocks versus bonds. That depends on your comfort level, your spending needs. It's more personalized.
What about target retirement funds, TRFs?
Mentioned as the ultimate simple option, especially in, say, a 401k. One fund does the allocation rebalancing, uses low-cost index funds. Very hands-off.
Now, a practical question. What if your work plan doesn't offer VTSAX or even Vanguard?
Good question. The book clarifies VTSAX, VBPLX are portfolios. Vanguard offers them in different classes.
Like Admiral shares, investor shares, ETFs.
Exactly. Different minimum investments, different expense ratios. Admiral needs more money, 10K, but is cheaper, 0.05%. Investor needs less, 3K, but costs a bit more, 0.17%. ETFs like VTI have no minimum, trade like stocks.
But if none of those are options?
Look for the equivalent from other good companies. Fidelity, T. Rowe Price, Schwab. Competitive pressure means they usually offer their own low-cost total stock market or S&P 500 index funds.
So find the cheapest, broadest index fund available?
That's the key. Get broad market exposure at the lowest cost you can find in your plan.
Why the preference for Vanguard when possible?
Briefly mentioned. Its unique ownership structure. It's owned by its funds, which means it's owned by you, the investor. So its interests are aligned with keeping costs low, unlike public companies that need profits for outside shareholders.
Makes sense. And that quick note about Vanguard HQ getting nuked?
Yeah, just reassurance that your assets aren't physically there. They're held by a separate custodian. Your money's safe, even in that unlikely scenario. Other disasters are beyond the scope.
Got it. Let's talk practicalities then. Accounts, taxes, getting the money out eventually. Tax-advantaged accounts are key, right?
Absolutely crucial. Think of them as special buckets protecting your investments from taxes year after year.
Like 401ks.
Yep. Employer plans. You get an upfront tax deduction, growth is tax deferred, pay taxes only on withdrawal, and that employer match.
Free money. Always take the free money.
Always. Then there are Roth 401k. No tax break now, but tax-free growth and tax-free withdrawals later. Very appealing.
What about IRAs?
You've got the deductible IRA tax break now, if eligible, deferred growth, taxed later, non-deductible IRA. Trickier. No tax break now, growth is deferred, but you have to track contributions carefully to avoid double tax later.
And the Roth IRA.
Often seen as better than the non-deductible if you qualify based on income. No deduction now, but tax-free growth, tax-free withdrawals, big pluses, withdrawal contributions, anytime penalty-free, and no RMDs.
No required minimum distributions forcing you to take money out late in life.
Right. Huge advantage for flexibility.
And health savings accounts, HSAs.
Yeah, for high-deductible health plans. These are amazing.
Yeah.
Triple tax advantage, deductible contributions, tax-free growth, tax-free withdrawals for medical costs.
And unused money rolls over.
Yep. Plus, after 65, you can take it out for any reason, just paying income tax like a regular IRA if it's not for medical. Really powerful tool.
The book uses a listener example to tie this together. 24-year-old, inheritance, good salary, saving 24%, has VTSAX in their 403(b).
Perfect case study. VTSAX is the right tool for accumulation. Use Admiral shares if the inheritance gets them over $10, otherwise investor shares.
And the book notes if they could hit 50% savings.
$35K a year. Dramatically speeds up the path to financial independence, or FI.
Their questions. The whole VTSAX everywhere. Taxable, Roth, 403(b).
Yep, perfectly fine during accumulation. The account type just determines the tax treatment. Moving the inheritance could be capital gains tax if it grew before they invested.
Lump sum versus dollar cost averaging, DTA, for the inheritance.
The book argues strongly. Invest the lump sum immediately. Don't DCA. Because historically, the market goes up more often than down. Getting the money working sooner is usually better. DCA is mostly managing psychology, not optimizing returns. If it helps you sleep, fine, but likely less effective.
Before we move to withdrawal, that point about financial advisors.
Yeah, the book takes a very skeptical stance here.
Conflict of interest is the core argument.
Pretty much. Advisors often make more selling complex, expensive products than simple, low-cost index funds. Those fees, 1%, 2%, they sound small.
But they compound too, negatively.
Exactly. The book shows how they can eat up a huge chunk, like maybe quarter or more, of your retirement income.
Ouch.
The author's view is stark. Nobody will care for your money better than you. Learn the simple path yourself, save the fees, probably get better results.
Okay, let's shift to preservation, living on the wealth, the Trinity study, the 4% rule.
Right. Historical study looking back found that withdrawing about 4% of your portfolio annually, adjusting for inflation, had a high success rate, like 96% of making the money last 30 years.
But don't take it as gospel.
Definitely not. The book warns against rigidity. Real life isn't a backtest. Retiring right into a crash like 07-08 would stress that 4% rule hard.
Flexibility is key.
Paramount.
Yeah.
Being willing to cut spending a bit in down years dramatically increases your odds of success and reduces stress.
What about the mechanics of withdrawing?
Think of all accounts, taxable, IRA, Roth, as one big portfolio for allocation. Keep reinvesting dividends while saving. When withdrawing, use non-investment income first.
Then sell off any weird old stuff, cats and dogs.
Yeah, any lingering high-cost funds or random stocks and taxable accounts, sell those, maybe harvest some losses to offset gains for tax purposes.
Then the suggested withdrawal order for tax efficiency.
Start with taxable accounts, VTSAX, then traditional IRA 401k, tapping bond VBTLX first, then stocks VTSAX. Lastly, tap the Roth IRA, VTSAX, saving that tax-free growth as long as possible.
And consider your tax bracket when hitting those traditional IRAs.
Right. Maybe do some Roth conversions while in a low bracket.
Again, flexibility seems to be the watchword.
Absolutely. Adaptability is security.
Let's touch on Social Security.
Okay. Created 1935. Life expectancy was shorter then. Age 65. Worked for the system's math.
Now, longer lives, boomers retiring, payouts exceed taxes.
Yep. The trust fund holds treasury bonds paid by taxpayers, but the surplus is projected to run out around 2033. After that, taxes might only cover maybe 75% of promised benefits.
So when to take it? 62 for less, 70 for more.
That's the trade-off. The break-even point between taking it early, say 62, versus waiting to full retirement age, say 66, is often estimated around age 84.
So it's a bet on your longevity.
Kind of.
Yeah.
And your spouse's, if relevant. Play the odds based on health and family history.
Will it collapse completely?
Unlikely, the book suggests, especially for those 55-plus bits. Congress will likely tinker. Smaller benefit promises, higher taxes, raise income caps, push retirement age higher, adjustments. But it'll likely persist.
Is it a good deal financially?
Probably not. If you're disciplined and invest well yourself, you could likely do better. But for society, as a safety net, the book sees it as necessary, beneficial.
So the recommendation.
Plan as if it won't be there. Build your own independence first.
And if it comes through.
It's a bonus. Gravy. Don't rely on it.
Okay, wrapping up. The book shifts tone a bit at the end, talks about a different kind of return.
Yeah, the joy of giving. There's a nice anecdote about the author buying dinner for Catholic school teachers. Cost $1,200.
And the feeling.
Described as most pure personal pleasure. It even inspired others, the chef, a wine donor, to chip in. A ripple effect of generosity.
It's a nice way to frame the purpose beyond just accumulating numbers, so the final reinforcement of the path.
Live below your means, save and invest the difference. Avoid debt. Aim high on savings, maybe 50%. Fund those accounts consistently.
Do that for 10 plus years. FI is achievable.
That's the promise. Then there's that final story. Muck in the Tahiti hotel. Seems random at first.
Buying a pineapple plantation site unseen. Getting a loan for a hotel with no experience.
Yeah. Apparently the bank lent them money because they were Americans with a reputation for getting things done.
Seriously?
That's the story. They leaned into it, finished the hotel, got rich.
Okay. So what's the takeaway from that?
It's about fear, I think. How perceived risk can hold us back. Mook and his friends just went for it.
Letting fear control you has its own risks. The risk of doing nothing.
Exactly. Missing opportunities. Getting past fear, whether it's market fear or fear of trying something new, allows you to navigate challenges, build freedom, pursue what you really value.
So understanding this path, the history, the mechanics, it disarms the fear of market drops.
That's the goal. So you don't panic. You stay focused on the long game, building wealth, achieving freedom.
Okay, quite a deep dive indeed. We went from saving basics and debt avoidance through index funds, market noise, accounts, taxes, withdrawals.
Even Social Security and giving. All viewed through this very direct, simple path lens.
And it really does seem to boil down to just a few consistent things.
Live below your means. Invest the difference wisely, mainly low-cost index funds. And absolutely avoid debt. That's the core.
So for you listening, what stands out from this? Any ideas here you might want to explore more based on this approach?